The idea of a bubble and it bursting right now is probably one of the most talked about topics in our economy right now. And that idea is something that is very important to understand. Now, in order to understand this, I'm going to kind of explain it by going in the past a little bit. So everything from, I would say, 2012 up to 2018, there was a growing bubble. Now, in our economy, it's not so much about how much money you have, but how much credit you can qualify for. Meaning that if you have $1,000, so you make $1,000 in 2 weeks at your job, and if you were to go to the store and something costed like $1,200, you could not afford that with just the money you had. But because our economy is based on credit, you can then go to the bank and get a credit card. And if, let's say, you get up to $1,000 worth of credit, you can then purchase that thing. And then you can only use $1,000 of your money and then borrow $200 from the bank. And then you can slowly pay it back. So you can use more money than what you actually have. It's money that doesn't exist, but that you are betting that will exist. Whether it be a job that you actually have or you have an asset that you're expecting to grow. Now, this is something that is very cool in our economy because it's a way that you can make debt work in your favor. Because if you have, let's say you want to start investing in real estate, you don't have the money to do that. So if you want to get out a loan and then purchase a home, like let's say it's a rundown home, and then you build it up, build the equity on it, and then resell it, then you can make money off of that and pay back the loan and make some profit if you can do the numbers correctly. The issue, however, comes when people start using their credit to buy stupid stuff, as in like shoes and clothes and designer bags and cars. And to me, there's nothing wrong with that if you have the money for it, but it's just the fact that people are using money that they don't have already to begin with that becomes bad, because then it's credit that is not going to give them anything back. Because if they were to buy that stuff, if they were to buy designer brands, that is only going to decrease in value significantly, and now they're losing money on top of already losing money because they borrowed money to begin with. And it's why the economy builds cheap money, because then once you have all this cheap money and a lot of people that are not using it to buy assets and buying other stuff with it, it tends to pop, because then you can't afford anymore, you can't borrow anymore, and the economy goes down. From the time of, again, I'm going to estimate at like 2012 to 2018-ish, you saw a big bubble growing because we had just gone back from our crash in 2008 when there was already another bubble that had bursted. See, back then when it came to the 2008 crash, people were buying homes that they could not afford, and they had no equity on it because then the home prices went down. And so there was no equity, so they couldn't even refinance for their house because the banks are not going to refinance a house when it was $400,000 they bought it for, and now it's worth $350,000. It doesn't make sense for them, so they're not going to do it for you. So then once this started happening, the banks started giving people money that they knew that they couldn't really qualify for, then that bubble bursted, right? And so now they changed the law to where you cannot do that anymore, and there's a lot of stipulations in place in order for you to actually get a home and get a mortgage that you can actually afford. So once everything got into place and we had, again, like 2011, 2012, and the economy started getting back into motion again, people started then borrowing money, as we always do, because that's our economy based, and people started growing their money, and we got this little big bubble. Now, the problem is that when it's a bunch of cheap money out there, then you kind of create inflation, because now there's money circulating, which means that now there's just a higher demand, and then supply tends to go down because of that fact, and so that's when things become an issue. So a good example for this, and this is kind of what happens to businesses because they need to grow too, because it's not just about investing, it's about building businesses. So when it came to businesses, a lot of them wanted to become non-profitable in the beginning so they can later become extremely profitable. What I mean by this is that you have, for example, a regular profitable business, right? You start up your own little company because you sell, I don't know, you sell candy, whatever. So you make candy, and let's say the candy, you make a profit of like $1. Like it takes, I don't know, 25 cents. You sell it for like 125, so then you make $1 profit, right? So you do that, and then you make money. Let's say within a year, let's say you're freaking successful, right? You make $1 million, just for the sake of the argument. So you make $1 million off these candy bars, right? So then what most people end up doing is that they take that $1 million and they reinvest it into the business. They take some money out for their own needs when it comes to bills and, you know, just like using money for vacation or whatever have you, you know, just regular stuff. That business builds relatively slowly because you're only really getting profits off the business by selling it. But if you're not actively selling it, it's not really doing anything because you're using that money instead to reinvest it as much as you can. You're using it for your own needs, which there's nothing wrong with that. That's sustainable and it's reliable. But the problem is that it's boring. So that becomes the issue because people want to explode. They want to have huge success, and they want to do it quickly. So in order to do this, people make non-profitable businesses. They take, this is the same scenario, right? The same person, right? And they have $1 million. So instead of, let's say that they have the means to do this, they do not take out any of that money for their own needs and instead reinvest the same $1 million into their own business again. So then once they do that, right, then they're gonna start looking out for other investors because now they wanna build on that money, right? So they have all the $1 million back into their business. They're showing people that my business is worth $1 million. Investors come in and let's say they invest $1 million. So they invest $1 million in that as well. So that's $2 million being reinvested back into the business. And then let's say you have more money because then they start selling ownerships in the form of stocks. So now they have this grand business with tons of marketing, tons of employees, tons of product, and they can build on it. And now their business is worth way more than the profitable business, even though they're non-profitable because the person never took out money from it. It's a grand business, and once you establish all those customers, then you can raise the price. So then instead of that candy bar you selling it for $1.25, you make it $5, and you're making a lot more money, and people tend to stay because now you're so established. So regardless if, let's say, half of your people start leaving you, there's still a bunch of customers still there that are going to be purchasing that same candy bar because they know you to be reliable and it's good. If the product is good, they're going to keep coming back regardless of how much you raise that price. Versus the person that is profitable, they cannot compete with that because their business, they haven't grown it enough, is not worth enough, and they haven't built a client base that's as strong as a non-profitable business. And a good example of this is actually Uber. So Uber, when it first started, they were non-profitable. They were going to different areas and showing their Uber app to people. And they were hoping that even though that when somebody were to get a ride, they weren't really making any money off of that. It was actually super cheap in the very beginning to get an Uber. So they weren't making any money, but they didn't really care because they were establishing themselves in different parts of the city and the country. And so now when it came to the point when they actually are able to raise the prices, and now people are going to Uber instead of taxis because taxis are a lot more money than an Uber, even with the increased value. And now it's something that's a common thing to say, like, oh, I'm gonna Uber. That has become so common. So that's kind of how non-profitable business make their success. And it's kind of the same degree of using credit because you are just making yourself look amazing and then becoming it, but at least it's backed by something. But when it's not backed by something, not done correctly, it can fall down drastically, and a huge bubble that you made then comes popping. And that's basically what we saw up until 2018, and then that's when you started seeing videos all over the internet saying that the bubble has to burst because that's just the nature of things. And then of course, with a bunch of eyes seeing these types of videos and economics saying that they're gonna be a crash at some point, they don't, because no one can predict the when. They can always predict what's gonna happen, and they were all right that there was going to be a bubble burst, but the problem is that nobody knows when. Nobody can predict the timing of it because you just can't. Any professional can't do that. So what ends up happening is that it starts to slow down the economy a little bit because people are then scared, so they want to keep their money because they're seeing that, okay, let me stop making investments because now the bubble is going to burst. I don't want to be on that side of the field when the bubble bursts. I want to be on the side that I have everything secured. I'm making investments, then it supposedly goes down, and then they can buy it for the low and then sell high again. That's just how people try to predict it. With all that happening, then they have to do something about it. So they have to lower interest rates so that you can start building up the economy again and showing that, okay, no, that's not happening. Things are still going strong. We still have a strong economy, so keep investing because that's how our economy runs. And that's all fine and dandy. Problem is that in 2020, that's when we had a burst, but it wasn't how we thought it was going to. It came in the form of a virus. Now, with COVID-19 happening in 2020 at March, the entire economy goes down because now they have to shut down businesses. Even here in Las Vegas, it was a ghost town. You saw all the casino lights that were once lit, now all off. It was a scary time. It was actually pretty freaky. And so now you have a bunch of people that are not working unless they're an essential worker. But having just essential businesses is not going to sustain the economy when you have a bunch of these other businesses that used to be. Because a majority of just my city, Las Vegas, is casinos. That drives a bunch of revenue to Las Vegas in the city, not so much the essential places. I mean, the essential workplaces like fast food places, I mean, that's cool, but doesn't do as much. So now the economy goes down, so what do they got to do? Well, they have to lower interest rates even more to fight this. So once the virus goes away and people are a little bit more comfortable with going outside, and there's still mask mandates, but they're not as strict as it was before. People are now not social distancing as much, and so things start going a little bit more. But again, people are still weirded out by the virus and how things are, and rightfully so, because it was a scary time for a lot of people and people lost a lot of their jobs. And so you really can't predict anything and you don't know what to do. So you're kind of just playing it by ear. So then when we get to 2021, now interest rates are record lows. You have never seen interest rates that low hitting to like 2% to 3%. And it's something that a lot of people got comfortable with because now you saw that, okay, I'm getting stimulus checks, I'm getting unemployment checks, and I'm getting lower interest rates. So then what they're gonna do, they're gonna start doing what they expected. They're gonna start using it to build the economy by buying stuff, whether it be a form of like actual assets or just for their own stuff, but it's still driving money and money circulating through the economy, which is the point of stimulating the economy with those checks. What ends up happening is that now they think that, okay, well, it's not gonna cause inflation because for whatever reason, the feds did not think that it was going to cause inflation, but that's exactly what it did. The money printing caused tons of inflation, and then the fact that there is now low supply because the builders cannot keep up with now that there's higher costs of building supplies. Now you have a supply issue and now you have an inflation issue, which brings us into 2022. Now that there is a war overseas between Russia and the Ukraine, and now that gas prices are freaking high, and honestly, it's sometimes not even worth it to go out anymore. And now that the home prices are now going up, they're like kind of steady right now, but they're still going up. Inflation is skyrocketing for just natural goods. Just go to the grocery store, everything's super expensive. And then interest rates are now going up to try to fight that inflation, and now it's a big mess for a lot of people. What do you do with this information? Now, it's not really my call to tell you anything because I'm not a financial advisor. I'm never gonna claim to be one unless I actually was one. But I just want to let you know that that is what's going on, because to understand what to do, you need to understand what's actually going on. So that's the concept of a bubble. So now that they're trying to cause inflation to go down by raising up interest rates, they're still saying that our economy is strong, and it is. Our housing market is really strong because now people, instead of back then 2008 when they lost a bunch of equity, now we have a bunch of equity. So it's a totally different way of how it was for our economy than it was back then, and we have to tackle it differently this time. With that being said, now we have this bubble again, and it's either going to burst, which I know that it is going to burst, but now it's a question of when again. What's going to happen to it? Are we going to see a price correction? Which we probably will, but it's a matter of how is it going to happen or what time of it. It's a bunch of speculations, a lot of uncertainty, and that is just kind of how it is right now. So the best way to figure out how you want to handle things, I highly recommend just understanding the economy right now, understand the financing world, and know how you can take your situation and try to build it up. Now, I am a real estate agent, and so I'm always going to tell people that you should buy real estate because that is the most secure form of an asset. And even if interest rates are high right now, if you lock it in sooner than later, you can lock in the interest rate how it is right now, and then once a price correction does come, which inevitably will, again, I can't predict the when, but it's going to happen because that's just how the nature of things go. What goes up must come down, and what's down must go up. So you can then refinance it, and then you can get a lower interest rate, and now there's actually equity that you have instead of back then when there was no equity in 2008. And that caused foreclosures, but now because there is equity and because the housing market is strong, it's not going to be foreclosures the way it was before because it's just not structured the same way as it was before. So with that being said, is that if you do want to still buy a home right now in this market, I highly recommend checking out this video that I just did. It's helpful tips on how to buy a home in 2022 because again, the economy is different, so you need to tackle it a little bit differently. Still kind of the same, but still kind of different. Now, I hope all of that really made sense, and if you have any more questions about this or have your own comments about this, definitely let me know down in the comment section below, and I'd love to answer it. Or if you have something that you want to say that I didn't mention, definitely let me know as well, because there's a bunch of stuff I honestly didn't cover, but then this video would be like an hour long if I covered everything. And also give me a big like if you enjoyed the video, or give me a dislike down below if you didn't enjoy the video. Either way, just rate it and it lets me know how to differentiate my videos or keep them the same. And also hit that subscribe button down below for more tips on everything real estate and then generally the financing world. But anyways, thank you very much for your time. I really appreciate it, and I'll see you on the next video.